This is into Chapter 6, Problem 2 from the CFA Institute textbook, Corporate Finance, A Practical Approach. And this problem is asking about stock splits, essentially. If a company's outstanding shares trade at a low price, the company would be most likely to consider the use of a. Okay, so a stock split is taking the existing shares and splitting them up into more shares, which would reduce the price. So what we're really looking at is a reverse stock split. And how that would work, if you look at the equity of a company, the market value of the equity, and if we look at a firm that's, say, worth $50 million, and they have, say, 10 million shares, then each share would be worth $5. Okay, now if they thought that that was just not a very good price for the shares, they wanted them to be higher, they could keep the exact same equity and do a reverse split. And a reverse split simply takes all those shares, and of those 10 million shares, let's say we were going to do a 5-for-1 reverse split. So all that means is we're going to take the 10 million shares and reduce them to 2 million. So if you owned 100 shares, we're going to take your 100 shares and then give you back 20. And the 20 we give you back are going to each be worth $25 now. So the value of your equity doesn't change. Now, typically companies do reverse stock splits to raise the price of the shares of stock. And you say, well, what's wrong with a $5 stock? Oftentimes, the problem you run into is that the share price drops under $1. And to continue being listed on the New York Stock Exchange, you have to have a share price over $1. And I believe the NASDAQ is like that as well. So with a lot of firms that get into some kind of financial difficulty and the share price drops precipitously, just to keep the share price over $1, they'll do the reverse split. But there was also an instance where Citibank shares, during the Great Recession, the share price of Citibank stock dropped to, it was around $4 a share, and people were trading it like they trade stock options because of the really low price on it. Everybody knew Citibank could get better eventually or go broke, stone broke, but most people were betting that the share price would recover. So you could actually trade and use a lot of leverage on these $4 shares, and so people were day trading it like crazy. And so Citibank did a 10-for-1 reverse split that raised the share price to 40, and then that took the day traders out of the equation and helped just keep the price stabilized. Now, a reverse share doesn't change the market value of the equity. It's still, in our example here, it's still $50 million. All we've done is change the price per share. And it's the equivalent of taking a stack of $1 bills. Say you had 100 $1 bills and you wanted 5 20s. Well, you'd do a reverse split and then trade your 100 $1 bills for 5 $20 bills. You still have $100, but now it's more manageable form.